Today, we're reviewing the basics of inflation, why it's important, and what it means for your portfolio and for markets. Inflation is simply a measure of the change in price of a basket of goods over a period of time. Headline inflation measures the change in price of all the goods that a typical American consumer purchases, such as clothing, electronics, and even healthcare services. Core inflation, which is more closely followed by markets and generally thought of as a better true gauge of inflation in an economy, removes products with significant price swings, such as food and energy. There are two main types of inflation: demand pull and cost push. Demand pull is generally regarded as healthy inflation, as strong economic growth leads to greater demand from consumers, which pushes the price of goods and services higher. Conversely, cost pull inflation results from suppliers having to increase the prices of their goods and services. One example of cost pull inflation is the effect from tariffs, as the government is artificially increasing the prices of goods received from abroad. One of the Federal Reserve's primary goals is to pursue stable prices within the U.S. economy, as both periods of rapidly rising prices and falling prices could both negatively impact economic growth. The Fed has a 2% target for inflation, as it believes inflation significantly above 2% could erode consumer purchasing power too rapidly, and inflation below 2% could lead to deflation or falling prices, in which consumers could be incentivized to wait for lower prices in the future, leading to a self-fulfilling cycle of falling demand. Thus, the Fed uses interest rates in an attempt to manage the economy and inflation. Typically, in the face of rising inflation, the Fed will hike short-term interest rates, and vice versa. Inflation readings, expectations, and the Fed's reaction to inflation are all items that we monitor when positioning client portfolios. That's it for this edition of the CapStrat Minute. Thanks for tuning in.